If you own a proprietary limited company and you've ever moved money from the company account into your personal account, a property deposit, a holiday, a car, you need to hear this because the ATO doesn't care that you own the company. As far as they're concerned, it's a separate legal entity. And when you pull the money out without the right structure, they treat that transfer as income, taxable at your full marginal rate. That means up to 47 cents on every dollar plus penalties. And you might be thinking, I've been doing this for years and no one said anything. That's the pattern we've seen across many of our clients. Everything looks fine until an audit letter lands from the ATO, followed by a large unexpected tax bill no one planned for. If that sounds familiar, or if you're worried it could be you next, you need to stick around for the next few minutes. You'll get 3 legal ways to take money out of your company. The structure that can cap your tax rate at 25 to 30%, and what to do if you've already been doing this wrong. Let's get started. Most business owners think the same way. I've built this company, the revenue is here because of me, so the money in that account is mine to use however I want. That triggers one of the most expensive tax rules in Australian business, and most owners don't find out about it until after they've already tripped it. The rule is called Division 7A, and if I had to explain it over a beer, it sounds like this. You took the company money that hasn't been taxed yet and spent it personally. The ATO says you owe tax on that. So how does this actually happen? Well, there's 2 ways we see consistently. First, the business owner needs a deposit for an investment property, the money sitting in the company account, so they just transfer it across and done. The second, this one catches people off guard. They're using the company card for personal stuff like groceries, fuel, or dinners. Each transaction is small, but over a year, it adds up, and every dollar of it is technically a loan from the company to the director. If you don't have a formal ATO compliant loan agreement in place, and most people don't, the ATO reclassifies those transfers as a deemed unfranked dividend. No franking credits, no offset, straight income, taxed at whatever your marginal rate is. So what's the worst case scenario? You could be hit with 47% tax on every dollar you moved to your personal account, plus penalties and interest. The transfer you thought was harmless just became the most expensive money you've ever touched. So if you can't just move it across, how do you actually get the money out of your own company? Well, there are 3 ways, just 3. And most owners are stuck on the first one without realizing the other 2 exist. Number 1, wages. This is what most accountants default to. You pay yourself a salary, the company claims a deduction, you pay tax at your marginal rate. It's simple, it's predictable, but not always the smartest option. Because if your business is profitable, you might be pushing yourself into a higher bracket for no reason. Number 2, dividends. Your company has already paid tax on its profit at 25%. That's the base rate for most small businesses. When you distribute those profits as a dividend, franking credits come attached. Those credits reduce the personal tax you owe. So if your marginal rate is 32.5% and the company has already paid 25%, you only owe the difference. Most small business owners have never had this explained to them. Number 3, Division 7A compliant loans. This is actually the same mechanic as the transfer that gets people into trouble. Money moves from the company to you, but with a documented loan agreement, a minimum interest rate set by the ATO, and a repayment schedule. It's useful when you need capital for something like a property deposit, but don't want to trigger a full income tax event right now. You might be thinking, just tell me which one to use. You don't pick one. A smart structure uses a combination of all 3, depending on what you need the money for and when you need it. So what does the right combination actually look like? Wages for your day-to-day living costs, dividends when the company is profitable and you want to extract surplus, Div 7A loans when you need capital without the immediate tax hit. That combination, which is tailored to your numbers, is how you keep the most and stay compliant. If you're watching this thinking your current setup might not be right, or you've never had anyone walk you through this with you properly, we work with business owners on exactly this. Links in the description. If you're watching this and you're realizing you've been pulling money out for the last couple of years with no formal arrangement, you're not alone, but you can't sit on it either. ATO's data matching is sharper than most people realize, and doing nothing is not a strategy. The ATO compares your reported income against your lifestyle and your property purchases. Property values, land titles, big ticket spending, they're cross-referencing all of it. If your reported income says 120,000 and your lifestyle says 300,000, that gap will get flagged. And you might be thinking, well, I've never been audited, so I'm probably fine. The single most common thing that triggers a review isn't dodgy claims or aggressive structures. It's late lodgements. It's just being late. Now, 3 things put you in the lowest risk category: clean, detailed records, lodge on time, pay on time. Do those 3 things and you've eliminated most of the risk before anything else matters. If you've already been getting it wrong, here's what to do this week. Get your records in order, every transfer documented. Then talk to an accountant, not Google, not ChatGPT, and specifically ask about retrospective Div 7A loan agreements. In a lot of cases, this can be cleaned up. A good accountant will know how. The fix isn't complicated. Clean records, a compliant loan agreement, and a structure that matches what your business actually needs. And if your current accountant hasn't raised any of this with you, that's worth a conversation, even if it's just to get a second opinion. And if you're looking at your setup right now and thinking it might not be right, or you've never had anyone walk you through your structure properly, we do this every day. Links in the description. Even if it's just a conversation to find out where you stand, that's worth more than guessing.